My value pick for the month of December 2017 is GameStop, ticker symbol GME. Now this video is intended to accompany an article I wrote about the company on Seeking Alpha. So if you haven't read it, go ahead and check that out. Now before I get to my DCF valuation, I want to talk about the company, its business segments, and its strategy going forward. So the presentation I have on the screen was given last month by the CFO at the BAML Leverage Finance Conference. Now, as a matter of disclosure, I am long GameStop, just in case you were wondering. So first I want to use this slide to talk about the various business segments GameStop has. There are 4 of them, as you can see here. The first on the left is the physical video game business, which is the largest business that GameStop has. It's got about $7 billion in revenue. They are the #1 market share, I guess, in this physical space in 13 countries. And I think this has got a $13 billion addressable market. But this is the segment that the market is the most concerned about, as physical sales are pressured by not only competition from the likes of Amazon, but also directly from the game publishers and the new consoles that allow you to download a lot of these games digitally, which makes the need for a physical disc obsolete, and therefore is a real threat to GameStop's business. And you'll see later on that GameStop is aware of this issue, acutely aware, and they're taking some measures to try and counter that and pivot the company. Then second, you've got the digital business. This is digital. This is kind of the currency, the digital currency for gaming, and that you can buy through GameStop. And also, I think there's some add-ons for games and stuff that GameStop sells. I was surprised. This is greater than $1 billion revenue run rate on this business. They think it's got an $8 billion addressable market. Collectibles is the third business segment, and this is the one that I am most excited about. GameStop a while ago acquired a company called ThinkGeek, and it was an online kind of retailer of collectibles, comic books, superhero, Star Wars memorabilia. I'm a big fan of that stuff, and I can definitely see a lot of people that are into that stuff really loving it. This is still relatively small compared to the other businesses, but it's growing fairly fast. And the management thinks that this is a $12 billion business on its way to $16 billion. You'll see later on in this presentation. And then the technology brands business is the last business segment, which in my mind is completely separate from the others. The collectible business, I think, fits nicely with the gaming business because it's got a lot of the same crowd there, and they can also sell these collectibles in the physical GameStop retail stores. But the technology brands business is more leveraging GameStop management skill at running kind of little retail shops. And so GameStop actually runs, I think it's about 1,400, somewhere in that range. They operate about 1,400 AT&T branded stores and about 50 Simply Mac stores. Now, for the AT&T branded stores, they've got an agreement. They're the largest authorized, third-party retailer for AT&T. When you go in there, you probably don't even know it's not AT&T. It's really GameStop running the store, but you would never know. And then Simply Mac, the way that the management described it is it's kind of an Apple store. It is an Apple store-like store for the markets that are not large enough maybe to support a full-fledged Apple store. And so I see that as a good business as well, but relatively small. So you can see from this slide that the company has been trying to transition and has done a fairly good job at transitioning since 2010, where 90% physical game of 90% of earnings is from physical games back then, to where they project in 2019 it'll be about half and half from physical gaming business and half from other business lines. which definitely they need to do if they're going to continue to survive. Um, we can brush over this. I've got this more in my DCF uh, presentation here shortly. You can kind of see the breakdown of profit by these kind of different categories here. But you can see actually the technology brands business right there, sort of in the middle, is a good chunk of their profits, and then and collectibles. You can also see how that's growing nicely. There was kind of disappointing news that this last quarter on the earnings call that the technology brands business until now it's been growing, but it actually kind of shrank due to some margin pressure this last quarter, year over year, and management described that as the kind of, it seems like a relationship issue between AT&T and GameStop, where AT&T wants them to push sales of DirecTV, which AT&T owns, and DirecTV related subscription products, and is trying to compensate more heavily commission wise for those type of sales versus this traditional wireless services. And so management kind of said a couple things. Number one, their teams in these stores have kind of been trained to upsell the wireless stuff, not necessarily DirecTV. And so it's kind of a retraining issue. If they're going to be more compensated on DirecTV, they need to be trained to sell that stuff. And then also just kind of fundamentally that AT&T, I guess, is kind of putting some pressure on the amount of commission or compensation that these third-party authorized retailers like GameStop can receive. But the CFO was optimistic that this could be overcome, and that AT&T doesn't want to squeeze their authorized retailers too much, because it really is a partnership, and it has to be worth the capital invested for GameStop to continue to invest in that business. So it is kind of a give and take. I think there's room for negotiation, and perhaps we see that the margins in that business go back up to where they were. Back here on guidance, I mean, you can see here, and I'll get into this more in the valuation, but they're predicting for this year net income between 320 million, 350 million. That's $3.10 to $3.40 earnings per share, with shares trading between $18 and $19. You're 5 to 6 multiple there on as far as valuation goes on the earnings, and so I think that there shows kind of this undervaluation, but it's not always the case that a low multiple means that you should go ahead and buy the stock. But I think the market is, showing that there is a lot of risk that it sees in GameStop and its future. And I like to look for situations that are highly uncertain, where maybe the market has overreacted and that it won't be as dramatic of a decline as thought. And I think that is the case with GameStop. And you can see that GameStop here from this chart has been reducing its store count at a fairly rapid clip over the last few years, because I think they started recognizing, early on that things were changing, and that they need to cut back on their costs and shut down the unprofitable stores. And that's what they've been doing. And I think as a shareholder, that's exactly what you'd want management to do, is to try and maximize profits. And they do have quite a big following. They've got 55 million Power Up Rewards members, and they've got over 7 million down here in this bottom right. It talks about 7 million paid memberships, and that that's not an insignificant number. And they've got this omni-channel thing they're trying to push, where you order on the web and pick up in the store. And I think Amazon acquiring Whole Foods. I think Alibaba in China is kind of showing us that the omni-channel model does have some merit, and having both physical and an online seamless type of a ordering system works. And so I think that's what they're trying to do as well. Um, Now, this slide is one of the most interesting slides, if not the most interesting slide in the entire slide deck. Now, I think here management is trying to show that although digital and downloaded games are a significant barrier to the company, that it does not necessarily mean the end of physical gaming, or at least anytime soon, the end of physical gaming. You can see here they're comparing, this to like books, music, movies, and how those have gone digital, but yet, the digital penetration levels are, none of them have really cracked 50%. And you can see that there are also some barriers for the digital downloads, at least for the time being, with connection speeds. But like the average download time for a game, and these games are huge. I know from my nephew that it takes a long time to download one of these games. You gotta, go to bed and wake up in the morning and hope that it's done downloading. But it take, upwards of more than 10 hours because of the size. And so I think that's kind of a somewhat of a small little moat around physical gaming until speeds get better. But you can see, just a matter of seconds for books and albums and movies, and yet the penetration still is less than 50%. And so I think they're trying to show from this slide that, hey, physical gaming still has a shelf life, and it may be longer than Mr. Market thinks. And to talk a little bit more about the technology brands business, like I said, they've got these AT&T branded stores. They actually also have some Cricket branded stores, which is the prepaid wireless platform for AT&T. And then the Simply Mac business, like I said, they have about 50 stores nationwide. But this slide is what I wanted to show, is kind of how GameStop is compensated for running these stores. They get, here's their margin rates for selling new kind of subscription services, additional lines, etc. Pretty hefty margins. And then they also get the subscriber management fee, which I didn't know until I listened to this presentation. Didn't realize. So they actually get a little bit of money for every customer that they sign up for that customer's life. Every time that customer pays their monthly bill and continues to be a customer, GameStop gets a cut of that. I don't know exactly how much that is, but it's just kind of cream on top. And then they also get money from selling, phones and products like that, 35, 65%, which is another thing that impacted their technology brands business this last quarter, is because the iPhone, they think the iPhone X, since it didn't come out until like November, and the iPhone 8 came out in September-ish. So iPhone 8 sales, they think, were kind of hampered by people holding out for the iPhone X, which would not be reflected until Q4, or this quarter that we're in. Collectibles, like I mentioned, they think by 2019 the overall market size will be grow to be about 16 billion. And I see it. Just kind of the Peter Lynch thing going on in the world. What you see, seems to me a lot more people are into these type of things nowadays. I know my kids are. I know my nieces and nephews are. Got a lot of friends that are into a lot of the Marvel superheroes, Pokemon, DC Comics, Harry Potter. And I think this is a great company to kind of capitalize on that trend, and I think they're doing a great job so far. And they expect to have their revenues approach $1 billion by 2019. This year it should be close to 700 million. And I think there is some overlap and synergies, I guess, with the gaming business, because it's a lot of that same crowd. And actually, they said a lot of their members will actually pay more or spend more on these collectibles than they do actually do on video games, which I thought was an interesting stat. So anyway, projected cash flow, 300 million for 2017, and this is kind of the breakdown of the capex that they have. And so, in the free cash flow, I take that to mean after capex, which seems about right based on my model. And so now I just will go ahead and talk about my model. So now going to my DCF valuation for GameStop, you'll see here's a summary of my DCF model, and you can see the revenues. Basically, what I've assumed on revenues here at the top is revenues from the base year, this last year, going from 8.7 billion, and then declining every year for the next 5 years by about 5%. And I think that's realistic, because of the pressure that they're seeing in the physical gaming space, kind of offset by growth in their collectibles and technology brands business. And then kind of the growth decline, or the revenues decline, slows down in years 6 through 10. They're roughly kind of flat, and then after year 10 kind of grows at the rate of the economy. I think that 2.37% was the rate of the 10-year treasury at the time I did this valuation. So you can see I'm projecting revenues, you can see down here, going from the 8.7 base year all the way down, every year kind of going down until you get back to year 10. So ending up around the $6.7 billion mark. So that's a substantial decline, about $2 billion decline in revenue over a 10-year period. I've assumed operating margins at 6%. And then you can see how that translates into EBIT, or operating earnings. And going kind of from 500, well, the base year up here, operating margins were around 6%. So I have operating margins staying about the same. So EBIT going from about 500 million down to 400 million, and so losing about 20%. And then after-tax operating margins going from 350 million down to 263 million. And then net reinvestment, and even though I have declining revenues and declining earnings, and typically that would denote that you don't typically you reinvest into your business to grow the business, and so theoretically you don't need to reinvest money back into the business when you're declining because it's not growing. But I actually think that the transition will have some costs. And so net reinvestment is the amount of capex above depreciation and amortization. And so I think net reinvestment or net capex is going to be, between $30 and $60 million a year over this period. And so that gives us our free cash flow. So right now, roughly around 300 million, 321 million, down to 200 million. So in the end, the terminal year, I think there'll be about 200 million in free cash flow, even with those declining revenues that I've assumed. And then you do the math, and down here you've got your the value of the operating assets at this 3.029 billion. Then you subtract out the debt and add back cash to get the value of the equity, which would be the value of the shares, and that's 2.667 billion divided by 101 million shares gives you a value per share of $26.27. Stock was trading, it's actually lower now, between $18 and $19. So I think there's about 40% upside from where the shares are to get to fair value. And so I do think you have quite a bit of a margin of safety in case things are actually worse than what I have assumed here. But I think there's also the opportunity that they successfully pivot and things maybe aren't as bad as people think with the retail environment and also with the pressure with the digital gaming downloads. Just like I saw you on the showed you on that slide with how in other areas like movies, books, music, digital penetration has stayed below 50%. In video games, you would think that um, digital penetration would be even harder just due to the sheer size of some of those games. Anyway, so I hope you've enjoyed this video. If you have, please go ahead and subscribe, and look forward to other stocks as I find them. Thanks.